Welcome back to the Wealthy Good Life podcast. We're diving deep into a topic that I think a lot of you are really going to find interesting, and that is Vanguard funds. Now, you've brought some great info on these low-cost investment options, and what I really want to do is break down why there's such a potentially powerful tool for building long-term wealth, without making it feel like you need a degree in finance to understand it.
That's the goal.
Exactly. And we're going to explore why Vanguard has kind of become like the go-to for so many investors, the different flavors of funds they offer, and how all of this might actually fit into, your own personalized investment strategy. So get ready to learn some really interesting stuff and come away with a much clearer picture of how these funds actually work, and how they can potentially benefit you.
Absolutely. It's really remarkable how Vanguard has kind of carved out this dominant position, I guess you could say, in the investment landscape, especially when you look at the other major players out there. You got BlackRock, you've got Merrill Lynch, Charles Schwab, Fidelity, all big names.
Big names, yeah.
But Vanguard really seems to stand out. And a core reason for that is their laser focus on keeping those fees low and really delivering on those long-term performance goals.
Yeah, and when we talk about fees, this is not just like some kind of abstract concept in the financial world.
Right.
This is real money that could be staying in your pocket. The information you shared really highlights how these fees that a lot of fund managers charge, these administrative fees, they can really chip away at your wealth. They're right up there with like carrying debt or overspending as like a major roadblock to building real financial security.
Yeah. It's kind of like, a silent drain on your returns year after year. And the numbers really paint a pretty stark picture.
Yeah.
Even a fee that might seem small on the surface, let's say 1% annually, doesn't sound like a lot. But over time, as your investments compound and grow, that 1% becomes a bigger and bigger chunk of your wealth.
Yeah, it's like the longer you let it sit there, the more it kind of takes a bite out of what you're earning, right?
Exactly. And Vanguard, they've built their whole model around keeping those costs down, which means that their investors get to keep a much larger share of their gains.
And how much lower are their fees, like on average, compared to the rest of the industry?
So their expense ratio, which is how they measure these fees,
Mm-hmm.
is on average a whopping 83% lower than the industry standard.
83%.
83%.
Yeah.
That is a massive difference. And it's not just about saving money.
Right.
The data really shows that a huge majority of their funds actually outperform their competitors.
Yeah, so you're not sacrificing performance just to get those lower fees, right?
No, absolutely not. You're getting, more bang for your buck in a sense. A full 87% of their mutual funds and ETFs have actually beaten their peer group averages over the past decade.
That's impressive.
It is impressive.
And, it's not just the numbers that speak for themselves. I mean, you think back to, the Oracle of Omaha himself, Warren Buffett. He gave a huge endorsement to Vanguard's low-cost index funds back in 2002.
Oh, yeah.
He basically said that people who invest in these types of funds are much more likely to get better results than those who go for the higher cost options. And, coming from a guy like Buffett, that's a pretty big deal.
It carries a lot of weight. And I think a big part of why Vanguard can keep those costs so low really comes down to how they're structured. It's very unique in the investment world. Unlike a lot of those other firms that are publicly traded or owned by like a small group of shareholders, Vanguard is owned by the investors themselves.
It's like a credit union almost, right?
Yeah, exactly. It's like a giant credit union for investors.
Yeah.
And that means their primary focus isn't on squeezing every last penny of profit for some external shareholders, but rather on doing what's best for the people who are actually invested in their funds.
Which makes sense because it naturally drives down the prices.
Exactly.
And the scale of their operation, I mean, it's mind-blowing. 30 million customers across roughly 170 countries, all benefiting from that super low average expense ratio of just 0.10%. I mean, it's incredible.
Yeah. It's a testament to the power of that investor-owned model.
Absolutely. And their commitment to keeping costs low isn't some like relic of the past either.
No.
You mentioned that they recently, in February of this year, 2025, they actually lowered the expense ratios on a significant 87 of their funds, which is projected to save their investors a collective $350 million. In 2025 alone.
Right. Yeah.
That's money back in people's pockets.
Absolutely. And, they've been pioneers in this low-cost approach for decades.
Yeah.
They actually launched the very first index fund
Right.
way back in 1976.
Wow.
And if you look at where they are now, it's really remarkable.
It's huge.
As of October 2024, they had a commanding 29% market share of all U.S. assets under management. That's over $10.1 trillion as of last month.
Yeah.
They're a true juggernaut in the investment world.
Yeah.
And it's all built on this foundation of keeping costs down for everyday investors.
Absolutely. Okay, so let's talk about what Vanguard is really best known for.
Okay.
And that's their ETFs and index mutual funds. Now, for people who are new to this world, can you break down what passive investing really means?
Sure. So index funds and ETFs, they're designed to, in essence, mirror the performance of a specific market benchmark, like the famous S&P 500. And that's really what we mean by passive investing.
Okay.
It's the opposite of having a fund manager actively trying to beat the market.
Okay, so instead of trying to pick winners and losers and time the market just right, they're basically saying we're going to ride the wave of the overall market.
Exactly.
Okay, so less risk, less volatility, but also potentially less reward.
Well, the goal isn't necessarily to beat the market, but to match it.
Gotcha.
And because there isn't this huge team of analysts and portfolio managers constantly researching and trading, the operational costs for these funds are typically much lower.
Which gets passed on to the investors.
Exactly. So yeah, lower fees, which can really add up over time.
Right, right. Now, does Vanguard offer only passive funds, or do they have actively managed funds too?
They actually do offer both. I think you mentioned earlier, they have over 70 actively managed funds here in the U.S. alone.
Right, right. But, based on what you're saying, and I'm sure a lot of our listeners already know this, the data tends to show that those actively managed funds, they often struggle to beat the market consistently over the long term.
Yeah.
And they typically have those higher fees, which, kind of eats away at the potential gains.
Exactly. And that's why a lot of investors, especially those focused on building wealth steadily over time, they really lean towards this passive approach using index funds and ETFs.
Yeah, it's like, let's embrace the market growth. Let's not try to outsmart it, right?
Right.
Okay, so let's talk about some specific Vanguard funds. And, full transparency, there are a ton of options out there, which can feel a little overwhelming. But let's start with one that a lot of people consider a staple, and that's the Vanguard 500 Index Fund Admiral Shares, ticker symbol VFIAX.
Yeah, VFIAX. That's a really solid core holding for a lot of portfolios. As the name suggests, it tracks the performance of the S&P 500. So you're essentially getting exposure to 500 of the largest publicly traded companies in the U.S. across all those different sectors. You've got, your tech giants like Microsoft, Apple, but then also healthcare leaders like United Health Group.
It's a broad mix, right?
Really broad. And the expense ratios, that annual cost to run the fund, it's tiny, just 0.04%. So for every $10,000 you've got invested, you're only paying $4 a year in fees.
That's nothing.
It's almost negligible.
Yeah.
And it pays dividends quarterly.
Okay.
Vanguard considers this kind of like a, cornerstone equity holding, so to speak, for a diversified portfolio. Of course, because it's focused on the stock market, it does carry an above-average risk rating. And to get those Admiral shares, you need a minimum initial investment of $3,000.
Okay, got it. So you get exposure to the biggest players in the U.S. economy, for a very low fee. Sounds like a really great starting point for a lot of people. Now, what about the Vanguard Dividend Growth Fund Investor, ticker symbol VDIGX?
Yeah, VDIGX, that's a bit different. Its strategy is all about finding those companies that not only pay dividends, but they have a history of increasing those dividend payments over time.
Oh, interesting. So they're not just looking for one-time dividend payers. They're looking for companies that are consistently growing their payouts.
Exactly. And that can be really appealing for investors who want to generate income from their investments.
Makes sense. What's the expense ratio on that one?
So it's a bit higher, 0.27%.
Okay.
Still low compared to the industry average. The minimum investment is also $3,000 for this one, and it pays those dividends semi-annually.
Okay.
Now, it does carry a higher risk level, again, because we're dealing with equities, but it's been performing really well lately.
Okay.
And I think it could be a really attractive option for investors who want that dividend income, but prefer the diversification of a mutual fund rather than trying to pick individual stocks.
Yeah, it's like getting that built-in diversification right out of the gate. Okay, so we've got VFIAX, which is kind of like the broad market S&P 500 play.
Yeah.
We've got VDIGX, which is targeting those dividend growers.
Right.
What about the Vanguard Total Stock Market Index Fund, ticker symbol VTSAX? Now, this one sounds like it might be even broader than the S&P 500 fund.
You got it. This one aims to capture the entire U.S. equity market, not just those large cap companies in the S&P.
Oh, okay.
So you're getting those mid-sized and small-sized publicly traded companies as well,
So it's really the whole spectrum of the stock market.
the whole spectrum.
Okay, so what's the expense ratio and the minimum investment for that one?
So the expense ratio is incredibly low, just 0.04%.
Wow.
And the minimum investment is $3,000. It pays out dividends quarterly. And since its inception, which was back in 2000 or so, it's delivered an average annual return of about 5.79%.
That's not bad. Not bad at all.
No, it's not bad at all, especially for the broad exposure you're getting.
Okay, so if you want to, like, own a little piece of every publicly traded company in America, this could be the way to do it.
Exactly.
Now, the Vanguard Star Fund, ticker symbol VGSTX, this one stands out because it has a lower minimum investment, just $1,000. What's the deal with this fund?
So this one's interesting. It's actually a fund of funds.
A fund of funds?
Yeah, so it's not directly investing in stocks and bonds itself.
Okay.
It's actually investing in a portfolio of 10 other actively managed Vanguard funds.
Oh, wow. Okay.
So you're getting exposure to both domestic and international stocks, as well as U.S. bonds, all through this one fund.
Okay, so it's like a diversified mix within a diversified mix.
Exactly.
Okay, what's the cost on that one?
So the total cost is 0.31%. They call it acquired fund fees and expenses.
Okay.
A little bit higher than some of the pure index funds we've talked about,
Right.
but it's still very reasonable.
Mm-hmm.
And it leans a bit more conservative in terms of its overall asset allocation.
Oh.
It's about 60% stocks, 40% bonds. So it's a lower risk option than a pure stock fund. And it pays those dividends out semi-annually.
Okay, so for someone who's maybe a little bit newer to investing, or maybe they don't have a ton of money to put in right away, this could be a really nice option.
Yeah, it's kind of like a simplified all-in-one investment solution.
Yeah, I like that. Okay, so let's talk about a fund that's a little more focused on growth, the Vanguard Growth Index Fund Admiral Shares, ticker symbol VIGAX.
So VIGX, this one specifically invests in large cap U.S. companies that have those strong growth characteristics.
Okay.
So think about companies that are expanding their operations, launching new products, things like that. It's got a super low expense ratio, just 0.05%.
Okay.
And it requires that $3,000 minimum to get started, with dividends paid out quarterly.
Mm.
But it's important to remember, with growth stocks, they don't always outperform the broader market, and there are some limitations on the types of securities this fund can hold.
Right. So it's not going to be right for everyone, but if you're specifically seeking that higher growth potential and you understand the risks, this could be a good fit.
Exactly.
Okay, so we've talked about a few different stock funds.
Right.
Now let's shift gears and talk about bonds. You mentioned the Vanguard Total Bond Market Index, ticker symbol VBTLX.
Yeah, so VBTLX invests across a really wide range of U.S. dollar-denominated investment-grade bonds. You're talking about U.S. Treasuries, government agency bonds, corporate bonds, mortgage-backed securities. It's a really diversified bond fund.
Okay, so lots of diversification within the bond market.
Exactly. And the expense ratio is really low, just 0.05% again.
Wow. Okay.
It has that $3,000 minimum investment to get in, and it pays those dividends out monthly. Now, bonds can be a really important part of a balanced portfolio, especially if you also have stocks, because they tend to move in opposite directions. So bonds can help smooth out the ride, so to speak.
Right, they can help reduce some of the volatility that you might see from stocks. And then, of course, it's important to remember bond prices do fluctuate with changes in interest rates. But generally, VBTLX is considered a really solid core bond holding.
Absolutely.
Okay, so that's kind of like the bond market equivalent of that total stock market fund, right?
Yeah, you could say that.
And then you also mentioned the Vanguard Balanced Index, ticker symbol VBIAX. This one seems to take that balancing act of stocks and bonds and put it into one fund.
That's exactly what it does. VBIAX is a single mutual fund, keeps a target allocation of roughly 60% stocks, 40% bonds.
Okay.
So you're getting that instant diversification, that balance, built right in.
Very convenient.
Very convenient. Expense ratio is 0.07%, $3,000 minimum, and it pays dividends quarterly.
Okay.
It's considered a medium risk investment because you got that mix of stocks and bonds.
Right.
And for people who want a diversified portfolio but don't want to have to, manage those individual allocations themselves, this is a great option.
Yeah, it's a good, set it and forget it kind of option. Okay, so we've got VBTLX, that broad bond market fund. We've got VBIAX, the balanced stock and bond fund. And then another fund that focuses on dividends is the Vanguard Dividend Appreciation Index Fund Admiral Shares, ticker symbol VTSAX. How does this one differ from that dividend growth fund we talked about earlier?
So VTAX, it also targets those high-quality companies with a history of increasing dividend payments. But it does it through an index-based approach.
Okay.
So it's tracking a specific index of these types of companies. The expense ratio is super low, 0.08%, $3,000 minimum to get started, and it pays dividends quarterly as well.
Okay.
Now, its primary goal is dividend appreciation, so there's a chance that its overall returns might be a little lower than the broader market sometimes.
Okay.
But it's generally considered a very stable, long-term option for investors who are really focused on that dividend income.
So a bit more of a slow and steady approach to dividend investing.
Exactly.
Okay, and then we also have the Vanguard Mid-Cap Index Fund Admiral Shares, ticker symbol VFIAX. This one is focused on a slightly different part of the market, targeting those medium-sized companies.
Right. So VFIAX invests in mid-caps. These are companies that are, bigger than small caps, but not quite as big as the large cap companies in the S&P 500.
Okay.
Now, they tend to be a bit more volatile than those larger companies,
Okay.
but they also have the potential for higher returns.
Okay.
So, a bit more risk, but a bit more potential reward as well.
Makes sense. What about the expense ratio and the minimum investment for that one?
The expense ratio is 0.05%, and the minimum is $3,000. It pays out dividends quarterly.
Okay.
So for investors who are comfortable with a little more volatility and they're looking for potentially higher growth, this could be a good option.
Got it. And then there's the Vanguard Short-Term Investment Grade Fund Investor Shares, ticker symbol VFSTX.
Yeah.
Now, this one sounds like it's kind of at the shorter end of the bond maturity spectrum.
Yeah, that's right. VFSTX invests in a portfolio of high and medium grade bonds, but they all have relatively short maturities.
Okay.
So we're talking corporate bonds, U.S. government bonds, and even asset-backed securities based on things like consumer loans. The expense ratio is 0.20%, which is a bit higher than some of those other bond funds we've talked about, but still pretty reasonable. The minimum is $3,000, and it pays dividends monthly.
Okay.
Because the bonds in this fund have those shorter maturities, the fund's price isn't expected to fluctuate as much.
Okay.
So it's a potential option for those who are looking for stable, short-term returns.
So it's all about that stability and shorter-term focus. Okay, and then we have the Vanguard Real Estate ETF, ticker symbol VNQ. This one's interesting because it gives you targeted exposure to a specific sector.
Yeah, VNQ, it's an exchange-traded fund, or ETF, that invests in real estate investment trusts. Those are commonly known as REITs.
Right.
And REITs are companies that own and manage all sorts of income-producing real estate, like hotels, office buildings, shopping malls, apartment complexes, things like that. The expense ratio is 0.12%. And you mentioned it has a $3,000 minimum, which would apply if you were holding this within a mutual fund account at Vanguard, but as an ETF, it doesn't have that minimum.
Got it.
And it pays those dividends out quarterly. So this ETF gives investors a way to get exposure to real estate without actually having to go out and buy properties themselves.
Yeah, that's definitely much easier than being a landlord.
Absolutely.
Okay, so we've covered quite a few mutual funds. Let's move on to some of the ETFs you mentioned.
Oh, good.
The first one is the Vanguard S&P 500 ETF, ticker symbol VOO. Now, this sounds pretty similar to that VFIAX mutual fund we talked about earlier.
It is. You're right. VOO is also designed to track the performance of the S&P 500, just like VFIAX.
Okay.
But being structured as an ETF gives it a few key advantages. First of all, the expense ratio is even lower, just 0.03%.
Wow. Okay.
And you don't need a minimum investment to buy shares. Okay. You can buy and sell it throughout the trading day, just like a regular stock. Plus, it tends to be more tax efficient than traditional mutual funds.
Right. Yeah, I've heard about that.
Historically, it's performed incredibly well. I mean, we're talking about a 10-year average annual return of 13.71% and a 1-year return of over 26%.
That's impressive.
It is, yeah.
And of course, it holds those 500 largest U.S. companies, so it's really the biggest ETF globally.
It's a cornerstone for a lot of portfolios.
Okay, so it's the ETF version of the S&P 500 index fund, and it offers even lower costs and more trading flexibility.
You got it.
Okay, what about the Vanguard Mega Cap ETF, ticker symbol MGC? This one seems to zero in on the biggest companies in the U.S. market.
It does. MDC, that one tracks the CRSP US Megacap Index.
Huh.
That index includes about 195 of the largest U.S. companies, those that have the biggest market capitalizations. So we're talking about the true giants of the American economy.
Yeah.
The expense ratio is 0.07%, and it's also had really strong historical returns. We're looking at a 10-year average of 14.35% and a 1-year return of almost 28%.
Wow. Okay.
Now, it does hold many of the same top companies as an S&P 500 fund,
Okay.
but the weighting of those companies might be a little bit different, which could lead to a slightly different risk and return profile.
Okay.
And it's also important to note this ETF includes both growth and value-oriented stocks within that mega cap universe.
Got it. So it's like a way to really, double down on those giants of the U.S. economy.
You could say that.
Okay.
Exactly.
And then there's a value-focused version of that as well. It's the Vanguard Mega Cap Value ETF, ticker symbol MGV.
Right, MGV. This one aims to track the CRSP US Mega Cap Value Index.
Okay.
And this index really zeroes in on those largest U.S. companies that have those specific value characteristics. They actually make up a huge portion of the overall U.S. market cap, something like 70%.
Wow.
It's a big chunk of the market. The expense ratio is also 0.07%. Historically, it's had a bit more moderate returns than that broader mega cap index. But it often pays out a higher dividend yield.
Interesting.
And this ETF tends to have more exposure to sectors like financials, healthcare, and industrials, and it typically has a lower weighting in those high-growth tech stocks.
Okay.
So it's a potential option for investors who are maybe a little more risk-averse and are looking for some potential value plays among those big companies.
Okay, so for those who are thinking long-term and maybe see some potential in those companies, that might be a little bit undervalued right now.
Exactly.
Okay, and then there's the Vanguard Russell 1000 Growth ETF, ticker symbol VONG. This one seems like it's hyper-focused on those growth-oriented stocks.
VONG, it invests in those stocks from the Russell 1000 index that are really showing those strong growth characteristics.
Okay.
Things like high price-to-book ratios, strong earnings, and sales growth forecasts.
Right.
The expense ratio is 0.07%, and it's delivered some really impressive historical performance.
Yeah.
A 10-year average annual return of over 17%, and a 1-year return of over 32%. But that potential for higher growth does come with a trade-off.
Yeah.
It typically has a lower dividend yield.
Okay.
And it's important to note that it has a significant concentration in some of those big growth names, companies like Apple, Microsoft, NVIDIA, and Amazon.
Right. So it's really riding those big growth trends in the market.
Yeah, it's really concentrated in those companies that are driving a lot of the market's growth.
Okay.
Exactly.
And then we also have some sector-specific ETFs.
Well-
You mentioned the Vanguard Healthcare ETF, ticker symbol VHT.
VHT, yeah. So this one invests in a really broad range of healthcare companies. We're talking about large, mid, and small cap companies involved in pharmaceuticals, medical devices, healthcare services, biotechnology, all sorts of stuff. The expense ratio is 0.09%. Now, it's had more moderate returns compared to some of those growth-focused ETFs.
Okay.
But the healthcare sector as a whole, it's often seen as having a lot of long-term growth potential, and it can be somewhat resilient during economic downturns.
Yeah, healthcare, it's always going to be needed.
Exactly. People are always going to need healthcare. And some of the top holdings in this ETF include Eli Lilly, United Health Group, and AbbVie.
Okay, so a good option for those who want to specifically target a sector that has, those long-term demographic trends behind it.
Absolutely.
And finally, in the ETF section, we have the Vanguard Information Technology ETF, ticker symbol VGT.
VGT, yeah. This one's all about tech stocks. You're getting exposure to hardware and software companies, semiconductor manufacturers, all across different market caps.
Okay.
The expense ratio is 0.09%.
Yeah.
And it's had some really strong historical returns as well, a 10-year average of over 21% and a 1-year return of over 25%.
Wow.
Now, tech is obviously a sector that's been driven by all sorts of trends, artificial intelligence, cloud computing, digital transformation, all that stuff.
It's a huge part of the market these days.
Absolutely. And this ETF, VGT, it offers a way to get in on that. But it's important to remember its performance is going to be heavily influenced by those biggest tech companies, Apple, Microsoft, Amazon, Google, those types of companies.
Right, the heavy hitters.
Exactly.
Okay, so we've talked about a ton of different Vanguard funds here.
We have.
Broad market index funds, sector-specific ETFs, value funds, growth funds, all sorts of stuff. But how does someone listening to this even begin to figure out which ones are right for their own financial situation?
That's the million-dollar question, right?
It is.
It really all starts with understanding your own unique financial goals.
Okay.
What are you actually trying to achieve? Are you saving for retirement? Maybe you're trying to buy a house in a few years. Maybe you're saving for your kids' education.
Right, everyone's got different goals.
Everyone's got different goals. And once you've got those goals clearly defined, then you can start developing an appropriate asset allocation strategy.
And what does that mean exactly?
So that basically means deciding how you're going to divide your investment dollars among those major asset classes. Stocks, bonds, maybe real estate, things like that.
Okay, so it's like the big picture.
Exactly.
Yeah.
And then within those asset classes, you can decide how to allocate further.
Okay.
For example, within stocks, do you want to have large caps, small caps, international stocks? What mix makes sense for you?
Right. So it's really about aligning the specific funds you choose with your overall objectives and, how much risk you're comfortable taking on.
Exactly. And, based on what we've talked about, Vanguard offers a lot of different options for different goals, risk tolerances, and time horizons. You mentioned that they've got funds designed for long-term growth, some focused on dividend income, some for specific industries, different geographic regions, different company sizes.
Right. And it's important to remember you can build that diversification over time as your financial situation changes.
Absolutely. You don't have to do it all at once.
Right. Okay, so we've talked about the different types of funds, the different goals they can help achieve. What else should people be thinking about when they're building their investment strategy with Vanguard funds?
Well, I think a key takeaway, and something we've touched on throughout this conversation, is the importance of diversification. Spreading your investments across different types of funds, different asset classes, that can help manage your risk. You don't want to have all your eggs in one basket, so to speak.
Right, right. Don't put all your money in, one company, one sector, or even one type of asset.
Exactly. And then, going back to those core concepts we talked about earlier, it's really important to keep those investment costs low. That's where those index funds and ETFs come in.
Right. So embrace the market. Don't try to beat it.
Right. And understand the difference between index funds, which are trying to match the market,
Hmm.
and